In this opportunity, we're going to talk about supply and demand. Supply and demand in economics is a relationship between the quantity of a commodity that producers wish to sell at various prices and the quantity that consumers wish to buy. It is the main model of price determination used in economic theory. The price of a commodity is determined by the interaction of supply and demand in the market. Supply and demand zones put the economic theory into a trading strategy using price charts. So, what are supply and demand zones in trading? Supply and demand zones are a popular analysis technique used in day trading. The zones are the periods of sideways price action that comes before explosive price moves and are typically marked using a rectangle tool. Supply and demand trading strategies use price returning to these zones as entry and exit criteria. This strategy is neutral, which means that it can be used in all types of markets. The supply zone marks the origin of a strong downtrend. It can be called a distribution zone as well. The demand zone marks the origin of a strong uptrend, which can be called accumulation zone. Let's make it easier. Let's talk about what are the three simplest concepts in trading financial markets. Think about it. If demand is greater than supply, the price goes up. When demand is equal to supply, the price goes sideways. And when supply is greater than demand, the price goes down. Price is always moving in phases of the above. There are uptrends and downtrends, or price ranges. Richard Wyckoff was one of the first market analysts to explain the interaction of these phases, giving them four labels. The first one is accumulation. The second one is the markup phase. The third one is distribution. And the fourth one is the markdown phase. It is in the understanding of Wyckoff's explanation of market price action that supply and demand zones are also known as accumulation and distribution zones. Wyckoff explained these phases by the action of the whales, which these days are big institutions like money center banks in Forex markets or hedge funds in the stock market. These big players can't just put their whole order into the market at once because such high volume would move the price immediately. So instead, they buy increments within a specified range. This causes what we see on the chart as a demand zone. Equally, when they're selling their position, it cannot be all done at once because the selling pressure would send the price sharply lower and reduce their profits because they would be forced to sell into a market in decline. This is caused by their own large orders. So again, instead of doing that, they sell over a period of time to minimize the market impact of their trades, which creates the supply zone. Eventually, the market will break in the way that these whales had been buying or selling, creating a period where supply and demand are out of balance. An example, a price trend. The actions of the whales create different types of supply and demand patterns. First, it is important to understand that there can be several periods of accumulation during an uptrend and several periods of distribution during downtrends. This means that just like in a classic technical analysis price patterns, there are supply and demand reversal patterns and supply and demand continuation patterns. This is important because understanding which phase the market is in at that moment helps us understand what is the underlying trend and how long it has been in place, which determines which are the best demand and supply zones to look for. In an old trend, you will want to look for reversals. In a new trend, you will want to look for continuations. So how do you mark supply and demand zones? Putting this theory into practice, the idea is to find a place on the chart where demand overcame supply for long trades, or where supply overcame demand for short trades. The first step is to identify the current market price. The second step, you have to look on the left of the chart. The third step, you have to look for big green or big black candles. The fourth step is to find the origin of the big candles. The last step is to mark the zone around this origin. If we go back to how to draw supply and demand zones, there are two types of candle zones to look for on a chart. Either one will precede a big price move. The first one is from a base, and the second one is from a single candle. Supply and demand from a base. In trading terms, A base is typically another way of referring to a bottom. But in the context of supply and demand, a base means a small series of candles, typically less than 10, in a tight consolidation, as you can see on the following image. In this example, you can see is a single Japanese candlestick. This is simply when one candle is enough to draw the zone. The two candlesticks together often form a classic Japanese candlestick pattern, like a hammer or a shooting star, or bullish and bearish engulfing candlesticks patterns, or a bullish and bearish engulfing candlestick pattern. How do you identify a strong supply and demand zone? Like in any form of technical analysis or trading strategy, there are strong signals and weak signals. To get the best trading results, we need to ignore the weak signals and take the strong ones. The perfect supply and demand trade setup will see the zones exhibiting all of these features. The first one is narrow price range. If the trading range that exceeds the breakout is too wide or has too many long wick candles, it shows uncertainty and is less likely to represent accumulation from a whale. Less than 10 candles. The demand or supply zone should ideally be around 10 candles. Accumulation and distribution can take a while. If they take too long, the zone may get exhausted before the retest later. Number 3. Strong price move. We want to see if the breakout candle is an extended range candle or ERC. This shows a strong price move that has significance. Fake out or spring. This is when the price temporarily breaks out in the opposite direction but then quickly reverses. This is a sign that big players use stop hunting to find extra liquidity for their accumulation or distribution.